In this week's video, we'll review the latest charts and data to help us answer the question, is the stock market forming a major top? We'll begin with possibly the most powerful concept in markets. The market does not care what you think, which also means the market does not care what Chris Schiavocco thinks, nor does the market care what Schiavocco Capital thinks. And we know with 100% certainty that looking out into the future, the market will not be impacted in any way by CCM's secular bull market thesis. Said another way, the market does not care about CCM's secular bull market thesis. It's always healthy to ask and answer, what happens if the secular bull market does not last until 2035? And instead, we're getting ready to enter a period of secular stagnation, similar to this window here and similar to this window here. It's also good to keep in mind, at some point in the future, the market is going to experience another major drawdown. In the 10 historical cases shown on your screen, the average drawdown in the U.S. markets over 50%. Thus, it's reasonable to ask ourselves, how will I know if I'm wrong? And how will I handle a window like this or a window like this? Right out of the gate, let's make it abundantly clear that this video uses weekly moving averages to illustrate basic concepts. Concepts that can help us with the question posed in this August 8th tweet. We often use a look like this in these videos on daily charts, so keep in mind we're using weekly charts here. Fastest moving average, the 10-week moving average in blue, all the way out to the 250-week moving average in dark blue. And since we're trying to illustrate concepts, let's remove the 10-week, the 20-week, and the 30-week, allowing us to see what a very strong weekly uptrend looks like. Blue, the fastest moving average, is on top. And in this case, black, the 250-week moving average, is on the bottom. So we all know this is a full-bore bullish look. A very strong trend has white space between the moving averages. Slopes are all up. Price tends to be above the moving averages. This is one extreme. And these are two examples of the other end of the spectrum, the bearish extremes. From a conceptual perspective, markets and market trends share similar characteristics to changes in weather patterns that tend to evolve over time. We don't go from one extreme to the other extreme in an instant. We don't go from one extreme to the other extreme in an instant. So this is our strong trend, sunny day at the beach look. And this is an example of a batten down the hatches, the hurricane is on the way look. It's pretty easy to see that this period and this period look significantly different relative to this period. We've just presented some good visuals. Now let's try to quantify some of this, because doing so can help us mitigate or improve the probability of mitigating major drawdowns. For example, from this point here in 1973, point A, the additional loss in the S&P 500 between point A and point B was over 44%. Now let's move to the left side of the screen. In the 1969 example, following the market's peak, late in 1968, the additional loss between point A and point B was almost 29%. Keep in mind, this is the additional loss. Think of it this way. From here to here, conceptually, that's mitigation 1. From here to here, you're transitioning into mitigation 2. Conceptually, from here to here, you're in mitigation 1. And between this point here and this window in here, you're transitioning to mitigation 2. Now we're going to take a closer look at this point here in 1969. Forget the moving averages. The weekly chart is in a downtrend. Price, the dotted line, is making a series of lower highs and lower lows. And it's noteworthy, it hasn't made a meaningful higher high in approximately a year. This is November of 1969. This is November of 1968. And the deterioration in the trend is shown in the moving averages. Look at the 10-week moving average. It too has not made a new all-time high in approximately a year. And when the 10-week moving average in blue tries to retake the 30-week moving average in green, it is rejected. And it's probably fair to say that November 14th, 1969 looks significantly different from our strong trend look that we discussed earlier in the video. The chart mid-November of 1969 spans approximately 1 year and 11 months. If we were to look at the exact same moving averages in early to mid-August of 2025, does our current profile look better, worse, or about the same? Are we seeing this type of vulnerability or deterioration? Because remember, from this point A here in 1969, after we could see all of this deterioration, measure it, and put it in a model, that knowledge proved to be extremely helpful. Because we could see all of this before the S&P 500 lost an additional 28.62%. Now let's compare the chart of the S&P that spans approximately 1 year and 11 months in mid-November 1969 to the same time period, 1 year and 11 months, using the same moving averages in 2025. Chart on your screen is dated as of the close on August 7th, 2025. And it's probably fair to say the chart on your screen here in 2025 is more similar to the strong trend look here relative to the concerning look in mid-November of 1969. So relative to the question, how do we monitor the thesis above, the thesis that assumes the bulls are wrong and they're wrong in a big way, and how do we adjust if needed? If the present day chart, early to mid-August 2025, starts to morph into something more like this, concerns would increase. And keep in mind, this is a way to monitor the deterioration in the net aggregate opinion of all market participants regarding all subjects on all time frames. The combination of fundamental factors is different in every case. But the concept of a bullish trend morphing into a bearish trend, especially from a fractal perspective, they look similar across all periods. Said another way, the peaking process in 1929 has a lot in common with the peaking process in early 1973, the peaking process in the spring of 2000, and the peaking process that began in October of 2007. How about this counter trend rally here in the 1973-74 bear market? When you're at this point here, you don't know you're in a devastating bear market, and you don't know that an additional loss of 44% is right around the corner. But you can see and measure the deterioration that took place from late 1972, early 1973 on the weekly chart, and October 26th, 1973. And it's probably fair to say this rollover look here looks worse, and it's more concerning relative to the look of the same chart on August 7th, 2025. We just recently printed a new weekly closing high, and the 10-week moving average is making a new high. That's in stark contrast to October 26, 1973. In October of 1973, the 10-week moving average hasn't made a new high for approximately 10 months. Same can be said for price, the S&P 500. And we could see and measure all of this deterioration before the market dropped an additional 44.08%. And this percentage here does not include the loss from here to here, meaning hypothetically at the peak, $1 million portfolio would for the most part be cut in half to $500,000. And nobody wants to see that. And nobody wants to be on the wrong side of the market for 944 calendar days, 944 painful calendar days as you see your net worth significantly reduced. And remember, we're using these moving averages to illustrate basic concepts. There's nothing magical about these moving averages or these charts. These concepts, relative to our approach, are used in a much broader weight of the evidence model. And you can surmise that the weight of the evidence changes significantly in this transition period here. And the fact that we're getting rollover looks on weekly moving averages that span from the blue 10-week moving average all the way out to the 90-week moving average here in silver, that's the process of traders and investors that have different time frames slowly coming to bearish conclusions at different rates. Early adopters up here, late adopters down here. And if we compare head-to-head the 1-year 11-month chart of the S&P 500 on October 26, 1973 to basically the same chart and basically the same time period in 2025, it's pretty easy to see that the present day looks more like this conceptually relative to this or this. Another key concept here, we're not using charts to predict anything. These are certainties on the screen on October 26, 1973. We're not surmising anything. We're not forecasting anything. This deterioration and the deterioration in the data helps us incrementally reassess the probability of good things happening relative to the probability of bad things happening. And the probability of bad things happening over here is quite a bit higher than it is in this window right here. And the probability of something bad happening here, and at this point in 1969, is quite a bit higher than the probability of bad things happening in late 1950. Now let's look at the present day on the right side of your screen here and compare it head-to-head to the 1972-73 case. The market loses an additional 44% from this point here to the bottom in October of 1974. Price hasn't made a new high in a long time. The weekly moving averages in here relative to price look significantly different from what we have in the present day. In fact, in the present day, we're almost back to a full-bore bullish look. Not a perfect strong trend example, but still, this is indicative in here of a strong trend longer term. This is the 70-week moving average here in brown, the 60-week in orange. It's a pretty strong trend look all the way down to the pink 160-day moving average. We don't have anything that strong in here. It's a much tighter cluster. You can see the moving averages are coming together. They're converging, telling us we should be open to a bigger move. Now, that bigger move could be bullish or bearish. But the short to intermediate term trend is for things to get worse, not better. Similar concepts here. Now, if we compare it to mid-November of 1969 head-to-head, look at price action up here. Haven't made a new high again in almost a year. We're right on the cusp, as of Thursday's close, of printing a new weekly all-time high. And price is above an upward-sloping 10-week moving average. And if we go over to the left side of the screen and take that 10-week moving average and draw a line point to point, 10-week here to 10-week here. Look at the slope of that line and compare and contrast the same line in August of 2025. Now let's do the same thing with the 100-week moving average in black, point to point. It's a stronger look over here. But remember, technical analysis is about subtle shifts, subtle differences. Can you see a subtle or even significant difference between the look of this chart and this chart? On the left, price has been rejected twice below that black line. On the right, price had a short stay and came down and kissed basically that same upward sloping 100-week moving average. We kissed it and we went on to print a higher high. That's bullish. In this case, we're rejected and we're about to make a lower low. This is a lot more concerning relative to this. And let's forget the moving averages. Let's just draw a simple point-to-point line. This is where price is here, and this is where price is here. The slope of that line is moving from the upper left to the lower right. If we draw the same line on the present day chart, from here to here, point to point, we are moving conceptually, or on a relative basis, from the lower left to the upper right. Downward sloping line for price, upward sloping line. Recent new high here, recent new low here. 10-week moving average hasn't made a new high in almost a year. 10-week moving average is printing a new high this week in 2025. Thus, if the present day chart starts to morph into something more like this, concerns would increase. And if the present day chart starts to exhibit deterioration similar to this window here, concerns would increase, and we would have to be willing to reassess the probabilities. Clients and regular viewers know nothing is easy. There are no magic bullets. That's why we're using a weight of the evidence approach. We've provided a lot of visuals. What does it look like if we quantify all of this? Let's focus on the secular volatility model, vulnerability score in the present day. Higher scores are better. They go from 0 to 100. This is indicative of a healthy secular trend, and a trend that at the moment hasn't deteriorated in a significant manner. Present day vulnerability score, 99.76. How did the scores look at this point A? In 1969, before the market lost an additional 29%, and at this point A here, before the S&P 500 took a gut-wrenching 44% drop between point A and point B. Keeping in mind our present-day score is hovering very close to 100. The score at point A in 1969, a much more vulnerable 29%. We can see, measure, and put in a model the deterioration in this window here. We can see, measure, and put in a model the deterioration between this point and this point. The score, it's still hovering around 100 in the present day. At point A in 1973, before the 44% drop, much more vulnerable at approximately 66%. If the present day score starts to move and deteriorate, similar to the deterioration here, concerns would increase. Similar to this deterioration in here, concerns would increase. During Friday's session, Kathy scored the market 99.97 intraday on August 8th, 2025. Thus, we're always asking and answering, does the data that we have in front of us and what we've seen in the rearview mirror, does it align with or contradict the thesis that we're in a secular bull market that could last until 2035, primarily driven by demographics? Notice I said primarily. There are numerous factors driving the present-day secular bull market. It's also fair to say the present-day chart in August of 2025, chart dated August 8th intraday, this looks a lot more like the secular bull market in this window here. Present day upper right looks a lot more like the secular bull market in this window here, relative to this period of secular stagnation and relative to this period of secular stagnation. We trade the chart in front of us, not what we think is going to happen. Late in 2024 and early in 2025, Many market participants were concerned about tariffs. Based on the charts and data in front of us, it's gone better than expected relative to those bearish forecasts late in 2024 and early in 2025. And since the concept on your screen still applies on August 8th, 2025, we all know that if we're going to properly identify a bearish turn like this, it's incredibly important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.